So tell us, top line, I was particularly interested in the likelihood of recession and how bad it might get.
So 91% of U.S. CEOs surveyed said that they believe there will be a recession in the next 12 months, and only 1/3 said it would be mild and short. And 51% of CEOs talked about the possibility of job force reductions in light of a potential recession. So while those are the headlines, it's also really interesting to note that 95% of CEOs are still very optimistic about growth prospects over the next 3 years, and they're thinking about transformational M&A. They're thinking about changing their organization through significant acquisitions and continuing the digital journey they've been on for the last 2.5 years.
That was one of the things that really struck me, that we think there's going to be a recession. We think it could be a bad recession, but we're looking to buy or merge at least. So perhaps people are thinking there could be a shakeout that could really shake out some opportunities for companies and get some valuations back down. They could afford them, do some things they wanted to do before.
There's no doubt about that. I certainly think the valuation story is one that, in the United States in particular, has been difficult for companies. But now some valuations are coming down with the stronger dollar. There's opportunities to acquire assets globally too, David.
So another thing you touched upon in your survey was ESG, environmental, social, and governance issues, which are somewhat controversial at this point. They've become very political in the United States, with some state governors and state legislatures really going after it. What's the attitude overall, if you can describe one, for CEOs toward ESG?
Well, what I noted in the survey is that 70% of CEOs are talking about ESG being positive for their financial performance, while at the same time, they've noted that they may have to tap the brakes somewhat during a recession. But for the longer term, CEOs are absolutely positive about ESG from a financial performance perspective. So what I'm thinking about there is the fact that our customers want to see us be more environmentally sustainable. Our employees want us to see us be more diverse and inclusive, along with being more friendly to the environment. So longer term, both customers, employees, certainly investors and lenders are going to be looking for us to walk the talk and ensure that we deliver on our ESG commitments.
One of the things we've seen change, in part because of the pandemic, maybe it was already starting to change, but it was a real trigger, is the relationship between employer and employee and our relationship to the workplace, the extent to which we work in the workplace as opposed to work from home. Did you learn anything about that, about what CEOs anticipate, about how that is evolving?
Yeah, so approximately 2/3 of the CEOs said that the future, the next several years, will be either remote or hybrid. So I think it's all about optimizing the hybrid structure at this point. And we're not seeing a major movement in the U.S. back to office at the moment.
So one thing I've got for you, actually, at KPMG, in a sense, back when I was in a law firm, when there was a downturn, it changed the nature of what we did in the law firm. We put less emphasis on some things, more on other areas. Are you preparing at KPMG for a downturn and what that might mean for your clients and what they have to pay attention to?
Well, when we think about our business, we're seeing with the opportunities for mergers and acquisition, the continued digital automation of business models and operating models, real opportunity in the market for our business, including our audit and tax business. With respect to our clients, we're trying to help them think about what is an optimal future with respect to the business models that they have, as well as trying to make those operating models more digitally efficient for the future. And it's really about operational efficiency and strategy at the moment.
Well, you are a CEO, of course, of a very big company at KPMG. As you look at CEOs saying, look, we're going to have a bit of a rough patch here, it looks like. We're going to have to take a look at our workforce. We may actually have fewer employees. Are you looking at belt tightening at KPMG?
Well, so we're seeing the current landscape as more of an opportunity. We need certain hot skills, and we're seeing a pretty robust demand for our services. We're also thinking, David, about the fact that during the early stages of the pandemic, there were some job cuts and a recession, and then the economy bounced back very quickly. We want to be prepared for a pretty quick return to growth if there is a downturn. And also, we think about the Great Resignation and what we learned during that time period, that people are our greatest asset. So we are planning for a pretty bright future at KPMG.
So I'm curious. I mean, obviously, this is interesting for us. I mean, that's why you're on. We're interested in what the CEOs are thinking. Do you operationalize this at KPMG? I mean, do you take a survey like this and say, look, we're going to change how we invest, the people we bring on, what we do, what we emphasize?
Yeah, we're certainly investing heavily in innovation and technology, much like all of our clients are doing today, to try to make sure that we are as efficient as possible for the future, but importantly, so that we can deliver the services that we deliver with excellence.
It's fascinating. And so, as you look at this, what's different in the people you're bringing into KPMG today than it was 5, 10 years ago?
So certainly much more focus on skills around data and analytics, skills around technology, certainly around cyber awareness and security. So there's no doubt that when you think about who we're bringing you today, those skills are very hot.
What's going on in the accounting industry more broadly that you see? And how much of your business really is accounting versus consultancy at this point?
So at KPMG in the U.S., it's approximately 40% advisory, consulting, and around a little more than 30% audit, and a little less than 30% in tax.
In a time of downturn, does the audit and tax go up because there are more problems with some of the companies?
Well, certainly during difficult times, we see companies needing our help. And so with respect to our audit business, it's largely an annuity business because we audit public companies. Yeah. Many organizations are trying to reimagine how they do tax, and they're seeing global minimum tax as a real possibility. So they're scenario planning. They're thinking about what the future holds, and we're seeing pretty robust demand in those areas too.